Ford's supply chain case study. In this video, we will dive into Ford's examination of its supply chain to evaluate whether the company should virtually integrate with the Dell Computers model. So sit back, relax, and let's dive into the world of cars. Don't forget to hit that subscribe button and ring the notification bell so you don't miss out on any of our future videos. So let's get started. In the dynamic world of the automotive industry, Ford Motor Company, a behemoth with over 370,000 employees and revenues surpassing $144 billion, faced an intricate problem. The sheer scale of its operations, underpinned by its rich history dating back to 1903, when it was founded by the visionary Henry Ford, presented unique supply chain challenges. Ford's core business was all about producing and distributing cars and trucks. However, there was more to its financial success. Substantial revenues and profits were generated from financial subsidiaries, primarily operating in North America and, to a lesser extent, in Europe and other parts of the world. By 1997, Ford had reported net income close to $7 billion and a 5-year average revenue growth rate of 6%, reflecting its robust market and financial position. Traditionally, Ford had fiercely competed with General Motors and Chrysler until the 1970s, when the landscape began to change. The emergence of Japanese automotive giants like Honda, Toyota, and Nissan created a more intense and competitive environment with overcapacitated auto markets. In response, Ford, along with General Motors and Chrysler, recognized the need to consolidate their industry. The objective was clear: to achieve higher product quality, reduce cycle times, and lower costs due to economies of scale, driven by an urgent need to deal with increasing global competition. The challenge of supplier complexity. However, this consolidation didn't come without its challenges. Merging with Daimler-Benz significantly expanded Ford's supplier database, both at home and abroad. A large number of suppliers inevitably made the supply chain more complex, expensive to manage, and challenging to control. To address these supply chain complexities, manage suppliers more effectively, enhance production processes, and ultimately lower costs, Ford launched the Ford 2000 Plan in 1995. This ambitious plan aimed at restructuring key processes such as order-to-delivery, OTD, and Ford Production System, FPS. The primary objective was to reduce OTD times from 60 days or more to just 15 days or less. FPS was introduced to transform the supply chain from a push-based model to a pull-based one. Ford also sought to reduce the number of suppliers, which had grown to several thousand over the years as the company expanded. The focus shifted from supplier selection based on cost to developing close long-term relationships with Tier 1 suppliers, who in turn managed Tier 2 and Tier 3 suppliers. Strategic initiatives to transform the supply chain. The core goal was to create a more cost-effective supply chain. Ford collaborated with its suppliers to offer expertise and techniques to help them enhance their operations. Additionally, Ford launched the Ford Retail Network, FRN, aimed at reducing competition among dealerships in the same vicinity. The goal was to have one unified dealer providing the highest level of customer experience. But as the digital era continued to unfold, Ford faced a pivotal decision. The director of supply chain systems, Takai, was grappling with whether to adopt Dell's integrated supply chain system or explore alternatives. Ford's supply chain, with its vast number of suppliers and intricate web of business relationships, posed a unique challenge. What is the recommended course of action? Embracing the virtual integration strategies that Dell had successfully employed. But this wasn't a simple transition. It involved various steps and considerations. 1. A new department and high-tech equipment. To make this transformation, Ford needed to establish a dedicated department to oversee new business processes. They had to invest in cutting-edge, high-tech equipment to modernize their operations. 2. Education and training. Implementing this new system required more than just technology. It needed the buy-in and understanding of their employees and other relevant parties. Educating them about the system and showcasing the benefits would be crucial. 3. A network of connectivity. Ford needed to connect their suppliers' computer systems to their master network. This level of integration would streamline the supply chain, creating a smoother and more efficient process. But this also meant bringing their customers into the loop and introducing them to this innovative way of purchasing automobiles. 4. Continuous review and improvement. Continuous improvement was a key aspect of the plan. Regular meetings were to be held to review and evaluate the new model's performance. Any recommendations for improvement would be noted and considered. Customer satisfaction and shareholder value. The ultimate goal was clear: customer satisfaction and increased shareholder value. While success was not guaranteed, careful planning, diligent control, and time invested would likely make this new system a valuable asset, giving Ford a competitive edge in the long run. However, there was one critical factor to consider. Dell and Ford operated in vastly different markets. Dell dealt in computer manufacturing and distribution, where customers didn't need to touch or feel the product before buying. All they required were competitive prices and suitable specs. In contrast, the automobile market was different. Customers often need to test drive a car before making a purchase. Implementing a model exactly like Dell's might not be the right fit for Ford. Identifying the issues, the case brought to light a range of long and short-term issues that Ford needed to address. The primary long-term issue was managing Ford's extensive database of business partners, suppliers, and sub-suppliers. With numerous suppliers and a more complex business network than companies like Dell, controlling and efficiently managing their supply chain has always been a challenge. Some of the short-term issues are: 1. Outdated infrastructure. Ford needed to address the lack of up-to-date IT infrastructure within its first and lower-level suppliers. The absence of proper IT technology could result in miscommunication, coordination issues, longer lead times, higher costs, and operational hassles. 2. Lack of direct end user control. Due to their sales structure through independent dealerships, Ford lacked control over the end users of their products. This lack of control, coupled with dealer markups, negatively affected their ability to manage the customer service experience effectively. IT-related issues. Ford had to grapple with several IT-related issues when determining which information technology strategy would work best for supplier interaction and ongoing engineering projects. 1. Ford's supplier base. This encompassed the shift toward a smaller number of suppliers to foster closer, long-term relationships, often referred to as Tier 1 suppliers. However, Tier 1 suppliers lacked the capital to invest in new technologies. 2. Purchasing organization. The challenge of merging the independent purchasing department with the product development area to work more closely, as seen in Dell's model. 3. Forecasting within the Ford 2000 projects. This included the Ford Production System and order-to-delivery initiatives. Accuracy in forecasting customer demand was critical for maintaining the continuous flow of materials and delivering vehicles within a 15-day turnaround. Exploring the alternatives. Alternative 1, a hybrid approach. One alternative proposed a blend of online and offline operations, allowing customers to customize and place orders online while maintaining physical dealerships as Ford Retail Network (FRN) outlets. The advantages were clear: offering customization for clients, expanding to a new customer segment with a preference for online ordering, reducing overhead and inventory costs, and regaining control over the customer service experience. However, this approach came with its own set of challenges. Implementing such a shift would be costly, time-consuming, and involve significant changes internally and externally. Independent dealers might raise concerns due to internal competition. Moreover, the supplier's ability to keep pace with Ford's modern IT technology was a critical concern. Alternative 2, a Dell-like virtual integration. The second alternative proposed a fully integrated supply chain, inspired by Dell's model. Ford and its suppliers would share information between their systems and the Internet, coordinating the flow of materials and production. All customer orders would be placed through Ford's website or by phone and then built, a complete shift to a pull system. This alternative promised a high degree of customization for customers, faster order fulfillment, and better control over customer service. It would also mean minimal inventory carrying costs, a shorter order lead time, improved demand forecasting, and enhanced relationships with both customers and suppliers. However, like any significant change, this alternative came with challenges. It would necessitate major changes in Ford's traditional processes and production methods. Given the potential risks and the fundamental differences between the automotive and computer industries, this option was risky. Losing dealerships could mean losing business to competitors. Change management would be expensive and emotionally sensitive. Recommendations: striking the balance. 1. Web-based supply chain system. For Ford to stay ahead technologically and maintain direct links to Tier 2 suppliers, investing in a web-based supply chain system was a logical step. This system would allow Tier 1 suppliers to leverage their IT capabilities without substantial capital investments in emerging technology. Tier 2 suppliers could access the system to input production progress and engage in future designs. This approach would offer a centralized design database, control access levels and security, and ensure Ford's ability to set its desired technological level. 2. Purchasing and product development collaboration. Realigning the purchasing department with product development presented an opportunity to cut costs and enhance efficiency. Collaborative proposals for standard components and batch cost reductions would be instrumental. This approach would not tie Ford to one supplier and still offer a diverse range of products for different Ford models. 3. Outsourced forecasting. With dealers not traditionally involved in forecasting customer demand, Ford could outsource this function to a third-party expert. The firm could work closely with each dealer or network of dealers, ensuring that they comprehend Ford's new process flows under the Ford 2000 project. This move, though costly, was necessary, given the potential impact of an inaccurate forecast on suppliers and customer satisfaction. Monitoring and control, ensuring success. The transition to the new system required careful monitoring and control. It was essential to assign an IT specialist as a liaison to coordinate all IT activities between suppliers and Ford, resolving any issues that arose to ensure a smooth flow of information. A reliable system to monitor online orders, track lead times, and guarantee customer satisfaction was needed. Regular customer satisfaction surveys, performance analysis every 6-8 months, and annual executive meetings would help track progress. In conclusion, paving the way for an efficient and profitable future. Ford's journey toward a more efficient and profitable future involved building strategic relationships, optimizing internal culture, and embracing technological advancements. The decision to combine a virtual integration business model with the existing supply chain opened new horizons. It was not a simple path, but with careful planning and forward-looking strategies, Ford aimed to navigate the changing automotive landscape with confidence and success. The future awaited with the promise of more efficient operations, satisfied customers, and enhanced shareholder value. Thanks for watching.